Hey everyone, welcome back to Corporate Decoder, the place where we dig through the dry documents so you don't have to. Today, we're cracking open Willis Lease Finance Corporation's latest quarterly report. Forget the sky-high jargon. We're bringing you the real story, the one that even your financial advisor might have missed. And it might surprise you, they're not just about leasing planes anymore. Tip before we jump in, if you're tired of corporate doublespeak and want the real deal, make sure you're subscribed. Also, come hang out with us and other finance nerds on our Discord channel. The link is in the description below. Let's get straight to the numbers. First up, their income statement. This is where we see how much money the company made, how much they spent, and what's left over. Right off the bat, total revenue rings in at $157, $197. 19 Holland, Fosdol, nice mine, dollars, $19 omtiod, last year. Seems like business is picking up. Let's dig into where that revenue is coming from. Lease rent revenue is their bread and butter. It increased by about 28%. Seems like they're getting more money from plane and engine leases. But the real story is in their spare parts sales. They shot up over 450%. That's not a typo. Spare parts sales now account for a sizable chunk of their income. Now, while we like big jumps, it's something to keep an eye on. Is this a one-time thing, or are they really getting into a new line of business? Of course, it costs money to make money. Depreciation, the cost of their equipment wearing down, also went up. It's not unexpected, but it eats into those profits. Another thing to note is general and administrative expenses. They jumped over 60%. That is a big increase, which tells us that the company may be spending a lot more on consultants and employees. Are they wasting money or investing in the future? I guess we will have to wait to see. Now, for the part nobody likes, debt. Net finance costs jumped a whopping 40%. This means it's getting more expensive for them to borrow money. In the current world of high interest rates, this is not surprising, and it might put a damper on their future plans to buy more equipment. So what does that mean for shareholders? Basic weighted average income per share went down from 3 to 230.44 to 230.40, 4 cents to 24 cents. While the company is making more, it's costing them more to do it. Now let's take a look at the balance sheet to understand their assets and debts. Think of it like a snapshot of the company's financial health at a specific moment. Cash tells us how much readily available money the company has, and they have $32 million in cash, which is good as they only had about $9 million last year. Equipment for operating leases is their main asset, worth over $2.5 billion. Then they have $2.2 billion in debt. That is a lot of leverage, something that needs to be handled correctly or bad things could happen. It's interesting to note that their goodwill is very low, close to zero. This tells us that they have not acquired companies, as those actions tend to increase goodwill, an intangible asset that represents the excess of the purchase price over the fair market value of identifiable net assets acquired. Next up, we have the cash flow statement, the money coming in and out. Net income, they earned $16.8 million this quarter, not too shabby. Big spending on equipment, around $30 million, so they are not afraid to keep investing on new assets. They got $7 million back by selling equipment. So they have a strategy where they sell existing assets to buy new ones. Big repayments on debt. They spent $169 million to pay off their debts, telling us that paying off their debts is a priority for the company. Overall, for financing activities, which includes repaying debt, they spent around $38 million this quarter. Let's dive into their debt. This is where things get interesting, and you can see that the IFRS 7 series has an interest rate of 8%. Also notice that a lot of their debt has floating rates, and this could have severe impacts if interest rates continue to rise. But wait, the company isn't completely exposed. They do something called cash flow hedging using derivatives, financial instruments that act like insurance. This potentially means they are not as exposed to interest rates because they are hedging against it. There's also mention of call options. This basically means they have the right to buy back some assets at a set price in the future. This could be a way to control future cost or benefit if the assets become more valuable. Time to dive into commitments. These are the purchase commitments of equipment that are expected to be satisfied within 5 fiscal years. They have a whopping $1.1 billion in those, telling us that the company is very optimistic about the future because this is a big commitment. Lastly, let's briefly peek at how they're compensating their employees. They mention a stock purchase plan for employees, which basically allows employees to buy the company's stock at a discount, meaning the company is confident about its success and wants employees to bet on them. Here we learn that they operate in 2 segments, leasing and spare parts, which tells us that they have diversified revenue streams. They are using stock plans to incentivize their employees, mostly based on service, a common practice for employee retention. They are also entering joint ventures, with one recent venture for the creation of a new engine test facility. So, summing it all up, the company is growing, betting on the future, trying to hedge its risks, and incentivizing employees and partners to get them aligned. That's a lot catch to my analysis. Is Willis Lease a good buy or not? Based on what I saw in the report, the company is definitely taking risks, and their debt is something to keep an eye on as interest rates rise. The good news is that they have a plan to pay their debts. The management team is incentivized, and the plane leasing business seems to be steady, and with the new venture, it looks like the company is well positioned to be a major player within its industry. Is their plan safe? Will the revenue from spare parts continue to be a source of revenue in the future, or is it a one-time thing? Will the management team lead the company to success, or will they be blinded by the current success? That remains to be seen. Activix, their stock price seems to be trading a little on the higher end right now, meaning the market is very bullish on the company, and they need to keep up. Overall, I would wait and see how they perform for the rest of the year and check their results again during their next report. Under the rest of the year and check their results again during their next report. Alright, that's our breakdown of Willis Lease Finance's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.